Welcome back to another deep dive here on Marginal Thoughts.
Great to be back.
Ever feel like everyone else knows some secret to making their money grow?
Yeah, like there's some code you haven't cracked yet.
Exactly. Like
Yeah,
this whole world of investing feels complicated.
it can seem that way.
But what if we told you that, understanding the basics isn't actually that hard?
And that there are simple tools out there.
Simple tools, yeah, that can really help you navigate it all. So today, we're going to try and demystify one of those key tools, investment funds.
Okay, good topic. Where should we start? Maybe an analogy.
Yeah, I like analogies. How about this? Imagine you're planning, say, a big party dinner, a potluck with friends.
Okay, potluck. Got it.
Instead of everyone just bringing like one single dish.
Which could get boring fast.
Right. You decide to pool your money, your resources, so one person gets the salads, another handles the main course.
Someone else brings dessert, drinks, the works.
Exactly. And by combining everyone's contributions, you end up with this amazing, diverse meal, much better than if you all just cooked one thing alone.
That's a really good way to put it. And well, that's basically what an investment fund does.
Okay.
It's a way for lots of investors, maybe hundreds or thousands, to pool their money together.
Pool the money.
And then that collected money gets invested in a whole variety of different things. Could be stocks in different companies, could be bonds, other assets.
Right. So instead of just buying one stock, you're buying into a whole collection.
Precisely. And the big benefit here, especially if you're just starting out, is pretty immediate.
Okay.
Let's say there's a fund, we'll call it the Growth Basics Fund, just for fun.
Okay. Growth basics.
It takes everyone's pooled money and invests it in, say, big, well-known companies. Apple, Microsoft, maybe some Google, Tesla, NVIDIA, you name it.
The big tech names, yeah.
So if you put even a small amount of money into this Growth Basics Fund,
Like maybe $100.
sure, even that, you're not just buying a tiny, tiny sliver of Apple. You're actually getting a small piece of ownership in all of those companies the fund holds.
Okay. So, bam, right away, you've got diversification.
That's the key word, diversification.
You're spread out across different companies with just that one single investment. It's like the potluck, a little taste of everything.
Exactly. You don't have to go out and buy individual shares of Apple and Microsoft and Google.
Which would cost a lot more money and be way more effort.
Right. And some funds, they take this diversification really seriously. You mentioned ETFs before we started, like Vanguard's VTI.
Yeah, I've heard of that one, VTI.
That single ETF holds stock in, well, almost all the publicly traded companies in the U.S. We're talking over 3,600 stocks.
Wow, over 3,000 with one purchase.
Yep. That kind of broad exposure is a massive advantage for beginners. It really reduces the risk, the chance that your whole investment tanks because one single company has a bad year.
Okay, that makes a lot of sense. Less reliance on any single company's fate.
Plus, another layer here is that some of these funds, not all, but some, are actually managed by professionals.
Professionals, like finance experts.
Yeah, people whose job it is to research investments and decide what the fund should buy and sell on behalf of all the investors.
Okay, so pooling money makes sense for diversification, maybe professional management, but then, like you said, you start hearing all these different terms. Mutual funds, index funds, ETFs. It feels like alphabet soup sometimes.
It really can. So, yeah, let's try and break down these big three, as you call them, get a handle on the differences.
Perfect. Where do we start? Mutual funds.
Let's do it. Mutual funds. These have been around the longest, really.
Yeah, right.
So like we said, it's a pool of money from many investors. The key thing that often distinguishes mutual funds is that they're typically managed by a professional fund manager or a team.
Right, the person making the decisions.
Exactly. This manager is actively making choices about what stocks, bonds, or other assets the fund should buy or sell. Their goal is usually to, well, grow the value of the fund over time, beat the market, maybe.
Where that idea of active versus passive management comes in, I hear those terms a lot.
Precisely. That's a crucial distinction. In an actively managed mutual fund, the manager is, actively trying to pick winners.
Doing research, analyzing trends.
All of that.
Yeah.
They're trying to select investments they think will outperform the overall market or their specific benchmark. They monitor things daily, make trades based on their strategy.
Okay, sounds like a lot of work.
It is. And because you're paying for that expertise and that active management.
There are fees involved.
Exactly, fees. These are usually talked about as an expense ratio.
Expense ratio. Okay, what is that exactly?
It's basically an annual fee, expressed as a percentage of your investment in the fund. It covers all the fund's operating costs, manager salary, administrative costs, marketing, everything.
And how much are we talking, typically?
Well, for an actively managed mutual fund, it might range from, say, 0.5% up to maybe 1.5% per year, sometimes even more.
1% might not sound like much.
Right. But it's important to remember that you pay this fee every year, whether the fund makes money or loses money. And over like 10, 20, 30 years, that fee can really eat into your overall returns. Think of it like a small slice taken out of your investment pie each year.
Okay, good to keep in mind. So active management expense ratios. What about actually like buying and selling these things? How does that work?
Yeah, that's another key difference with mutual funds. You typically only buy or sell shares at the end of the trading day.
Only at the end, not during the day.
Nope. When you put in an order to buy or sell, it gets processed after the stock market closes for the day. And the price you get is based on the fund's value calculated at that closing time. It's called the net asset value, or NAV.
Ah, the NAV, right. So you don't know the exact price when you place the order during the day.
Correct. You get the end-of-day price. And one more thing, particularly relevant for beginners. Many mutual funds, especially the actively managed ones, have a minimum investment amount.
A minimum. Like you need a certain amount just to get started.
Yeah, it could be $500, could be $1,000, sometimes even $3,000 or $5,000. That can sometimes be a hurdle if you're just starting out and only have a smaller amount to invest initially.
Okay, yeah, that could definitely be a barrier. So, recapping mutual funds, often actively managed, professional picking stocks, potentially higher fees due to that, traded only at the end of day price, NAV, and sometimes have minimum investment requirements. Any quick examples?
Sure, some well-known actively managed ones might be like Vanguard's Prime Cap Fund, VPMAX,
Yeah.
Fidelity's Blue Chip Growth, FBGRX, or T. Rowe Price, Blue Chip Growth. Lots out there.
Got it. Okay, that helps clarify mutual funds. Now let's tackle index funds. You mentioned these are often passively managed.
Yes, exactly. Index funds take a very different approach. Their goal isn't really to beat the market.
Okay, so what is their goal?
It's simply to match or track the performance of a specific market index as closely as possible.
Right. You mentioned indexes earlier. So what exactly is an index again? Give me an example.
Sure. Probably the most famous one in the U.S. is the S&P 500.
Heard of that one?
It's basically just a list of 500 of the largest publicly traded companies in the United States. Think Apple, Microsoft, Amazon, Johnson & Johnson. Big, established companies. It represents a really significant chunk, maybe 80% of the total value of the U.S. stock market.
Wow, 80%. Just from those 500.
Roughly, yeah.
Yeah.
Another common one is the NASDAQ 100. That one's more focused on the biggest non-financial companies listed on the NASDAQ stock exchange, so it tends to be heavy on technology companies.
Like the ones you mentioned for the Growth Basics Fund earlier.
Exactly. And there are tons of other indexes, too. Indexes for small companies, for international stocks, for specific industries like healthcare or energy, for bonds. You name it, there's probably an index for it.
So an index is kind of like a recipe or a blueprint for a specific part of the market.
That's a great way to think about it. A recipe or a blueprint. And an index fund just tries to follow that recipe exactly.
How does it do that?
Well, if you invest in an S&P 500 index fund, the fund's job is essentially to buy shares in all 500 companies that are currently in the S&P 500 index.
All 500. Wow.
Yep, and it tries to hold them in roughly the same proportions as they exist in the index itself. So if Apple makes up, say, 7% of the S&P 500's total value, the fund will aim to have about 7% of its money invested in Apple stock.
Okay, so it just mirrors the index. What happens if a company gets added to the S&P 500 or one gets kicked out?
Good question. The fund manager, even though it's passive, there's still someone overseeing it, will adjust the fund's holdings accordingly. They'll buy the new company's stock and sell the one that got removed just to keep matching the index blueprint.
Okay, but they're not making active decisions about whether Apple is a good buy right now.
Nope. No active stock picking, no trying to time the market. It's a much more automated, rules-based process, and because of that,
The costs are lower.
generally, yes, significantly lower. Since you don't need a big team of highly paid analysts constantly researching and trading stocks, the operating expenses for index funds are typically much lower than for actively managed funds.
That sounds appealing. Why else are index funds often suggested for beginners?
Well, a few key reasons. First, as we discussed, they're pretty easy to understand. Investing in an S&P 500 index fund means you know you're getting broad exposure to a huge part of the U.S. economy. Simple concept.
Okay, simple. What else?
Second, those low fees we mentioned. The expense ratios are often very low, maybe below 0.5%, sometimes even close to zero these days for certain funds.
Wow. Near zero.
Yeah, competition is fierce.
Echo.
And over the long haul, saving even a fraction of a percent each year on fees can make a really noticeable difference in how much your money grows. It's like keeping more of your potluck contribution for yourself, like you said earlier.
Right, compounding the savings too.
Exactly. And third, there's the performance aspect. It might sound counterintuitive, but historically, especially in the U.S. market, it's been surprisingly difficult for most active fund managers to consistently do better than broad market indexes like the S&P 500 over long periods, especially after you factor in their higher fees.
So trying to beat the market is actually really hard.
It's very hard to do consistently year after year. So many argue, why pay higher fees for active management when a low-cost index fund often delivers very similar or sometimes even better long-term results just by tracking the market?
Lower fees, easier to understand, potentially similar or better long-term performance. Sounds like a compelling case for beginners.
It often is.
Now, you mentioned earlier that index funds can come in different structures, like they can be mutual funds or ETFs.
Correct. You can access that same index tracking strategy like following the S&P 500 through either a mutual fund structure or an ETF structure.
So if I bought an index mutual fund, say one that tracks the S&P 500, it would still have that end-of-day trading rule, the NAV pricing.
It's exactly right. An index mutual fund operates like other mutual funds in terms of trading end-of-day pricing based on NAV. And it might still have a minimum investment requirement, though sometimes index mutual funds have lower minimums than their actively managed counterparts.
Okay. Any examples of those index mutual funds?
Sure, some very popular ones are Vanguard's 500 Index Fund Admiral Shares, VFIAX, Fidelity's Zero Large Cap Index Fund, FNILX, that's one with a zero expense ratio, or Schwab's S&P 500 Index Fund, SWPPX.
Got it. VFIAX, FNILX, SWPPX. Okay. But then there's this other way, the ETF way.
Right, ETFs, exchange-traded funds.
These seem to be everywhere now. They get a lot of buzz. What makes an ETF different from an index mutual fund if they might be tracking the same index?
The biggest difference, and probably the most important one for beginners to grasp, is how they are bought and sold.
How they trade.
Yeah. Unlike mutual funds that only trade once a day at the closing NAV price,
ETFs trade differently.
ETFs trade on stock exchanges throughout the trading day, just like individual stocks, like buying shares of Apple or Microsoft.
Oh, so if the stock market is open, say it's 11 a.m., I can go onto my brokerage account and buy or sell shares of an ETF at whatever price it's currently trading at that very moment.
Precisely. You see the price fluctuating during the day, and you can place an order to buy or sell at that current market price. That intraday trading flexibility is a key feature.
I can see how that might appeal to some people. Any other big differences for beginners?
Yes. Another really significant one is the minimum investment.
Ah, the minimums again.
With ETFs, there often is no minimum investment, or it's very low. You can typically buy just a single share of an ETF.
Just one share. How much might that cost?
It depends on the ETF, of course, but many popular ones trade for, maybe $50, $100, $200, $400 a share. So you could potentially start investing with a relatively small amount.
Way less than the potential thousands for some mutual funds.
Exactly. And even better, many newer brokerage platforms now let you buy fractional shares of ETFs.
Fractional shares, meaning I don't even have to buy a whole share.
Right. You could maybe invest just $10 or $20 in an ETF. Even if one full share costs $200, you'd just own a fraction, like 0.1 shares.
Okay, wow. That really, really lowers the barrier to entry for someone just starting out, maybe only putting aside $50 a month or something.
It absolutely does. Makes it incredibly accessible.
So treating like a stock, low or no minimums, fractional shares available. What about the management? Are most ETFs passive index trackers like the index mutual funds?
The vast, vast majority of ETFs out there are passively managed. They're designed to track a specific index, just like their index mutual fund cousins.
So I can find an ETF that tracks the S&P 500.
Oh, yeah. Very popular ones like Vanguard's VOO, iShares IVV, State Street's SPY, they all track the S&P 500.
What about other indexes, like that NASDAQ 100?
Yep. Invesco's QQQ is probably the most well-known ETF that tracks the NASDAQ 100.
And broader markets, like everything.
Sure. Vanguard's VT tracks a global index of both U.S. and international stocks. VanEck's SMH focuses just on semiconductor companies. There are ETFs for bonds, for real estate, for commodities.
Even like crypto? I feel like I've heard about Bitcoin ETFs.
Yes. More recently, ETFs that track the price of cryptocurrencies like Bitcoin have become available too. So the range of underlying investments you can access through an ETF's wrapper is enormous.
A huge variety. But I think you might have mentioned earlier, are there actively managed ETFs too, or are they all passive?
Good catch. While most are passive, there is a growing segment of actively managed ETFs.
Okay, so similar to active mutual funds.
In principle, yes. They have a fund manager or a team who is actively making investment decisions, trying to pick stocks or time the market to outperform some benchmark.
And I assume they have higher fees.
Generally, yes.
Yeah.
Just like actively managed mutual funds, these actively managed ETFs tend to have higher expense ratios than the passive index tracking ETFs because you're paying for that active management.
Any examples spring to mind?
Sure, some well-known ones include ARK Innovation ETF, ARKK, Fidelity Blue Chip Growth ETF, FBCG, or T. Rowe Price Blue Chip Growth ETF, TCHP. You'll notice some overlap in names with the mutual funds we mentioned earlier. Sometimes firms offer both versions.
Interesting. So it really sounds like for the most part, especially with index tracking, an ETF is kind of like a different package or wrapper for the same underlying investments you might find in an index mutual fund.
That's a perfect way to describe it, a different wrapper.
You gave the example of Vanguard's total stock market index. They have the VTSAX mutual fund and the VTI ETF.
Right, or the Vanguard S&P 500 Index, VETFI AX is the mutual fund, VOO is the ETF.
Same basic ingredients inside, same index they're tracking, but the ETF wrapper lets you trade it during the day like a stock and often has lower minimums.
Exactly. Those are the key functional differences from a beginner's perspective. Trading flexibility, intraday for ETFs versus end-of-day for mutual funds, and minimum investment. Often none or low for ETFs versus potentially higher for mutual funds.
What about fees between, say, an index mutual fund and its equivalent index ETF from the same company? Are they usually similar?
Often, yes. The expense ratios for the index tracking versions can be very similar and very low for both structures, especially from major providers like Vanguard, Fidelity, or Schwab.
Okay. Are there any other cost differences to think about, like fees to actually buy or sell them?
That's a good point. Traditionally, buying mutual funds directly from the fund company, like buying a Vanguard fund on Vanguard's website, is often free of transaction fees. But if you buy a mutual fund from one company through a brokerage account at a different company, there might be a transaction fee.
Ah, okay. What about ETFs?
ETFs trade like stocks, so historically there used to be brokerage commissions for stock trades.
Yeah.
However, these days, most major online brokerage platforms in the U.S. offer commission-free trading for stocks and ETFs.
So buying and selling ETFs is often free now on many platforms.
Very often, yes. Which is another plus for beginners, especially if you plan to invest small amounts regularly. Those commission costs used to add up.
And fractional shares, you said they're available for ETFs now, but were they always?
Fractional shares were actually more common with mutual funds first, because you typically invest a dollar amount anyway, and they calculate how many shares, including fractions, that buys at the end of day NAV. But yes, now many brokerages have enabled fractional share trading for ETFs too, increasing their accessibility.
Okay, this is super helpful. We've covered mutual funds, index funds, ETFs.
Yeah.
Breaking down the key differences. There's one other term that sometimes floats around hedge funds. You sort of brushed past it earlier, saying they aren't really for beginners.
Right. Yeah, hedge funds. Worth mentioning just for context, maybe?
Just briefly, what are they?
So hedge funds are generally investment funds designed for very wealthy individuals and institutional investors, like pension funds or endowments. They're usually not available to the general public.
Why not?
Mainly because the minimum investment amounts are typically extremely high. We're talking hundreds of thousands, often millions of dollars just to get in.
Whoa. Okay, definitely not beginner territory.
Not at all. And they also tend to use much more complex, sometimes aggressive or risky investment strategies compared to mutual funds or ETFs.
Like what?
Things like heavy use of leverage, borrowed money, short selling, betting against a stock, derivatives, investing in less common assets. The goal is often to generate high returns, regardless of how the overall market is doing, but that comes with higher risks.
And are they actively managed?
Almost always, yes. Highly active management. And their fee structure is also quite different. You often hear about 2 and 20.
2 and 20.
Yeah, it typically means they charge a 2% annual management fee on the assets, plus they take 20% of any profits the fund generates above a certain threshold. So potentially very high fees if they perform well.
Okay, so super high minimums, complex strategies, high fees. Definitely sounds like something the average beginner doesn't need to worry about right now.
Exactly. It operates in a different sphere. Good to know the term exists, but not really relevant for most people starting their investment journey.
Right. Okay, so putting hedge funds aside, let's circle back to the main three: mutual funds, index funds, ETFs. After breaking all this down, if someone listening is brand new, just starting out, what's generally considered a good starting point? Which one is best?
Ah, the best question. Well, there's no single best for everyone, but we can definitely highlight the pros and cons for beginners.
Okay.
As we've discussed, if you value being able to buy and sell throughout the day, or if you see the price of something you want to buy dip during the day and want to act on it, ETFs offer that flexibility.
Right, the intraday trading.
And perhaps more importantly, for many beginners, the minimum investment hurdle is usually much lower or non-existent with ETFs. You can often start with whatever amount you have, even if it's small, especially with fractional shares.
That accessibility seems huge.
It really is. Now, in terms of cost, the key is generally to look for low expense ratios. And this is where passively managed index funds really shine, whether they're structured as a mutual fund or an ETF.
So low cost is crucial.
Absolutely crucial, especially for long-term investing. Paying less in fees means more of your money and more of the market's returns stay in your pocket, compounding over time. Passively managed index options generally win on cost.
And what about performance? You touched on this, but does active management tend to pay off?
Well, as I mentioned, the historical data, particularly in the broad U.S. stock market, suggests that most active managers don't consistently outperform their benchmark index over the long run, especially after you account for their higher fees. Some do, for periods, but it's very hard to pick them in advance.
So chasing those star active managers might not be the best strategy for a beginner.
For many beginners, sticking with a low-cost, broadly diversified index fund or ETF is often considered a more reliable and less stressful approach. You're essentially aiming to capture the return of the market itself, rather than trying to beat it.
Okay, so the key takeaway seems to be focus on low-cost diversified options. And for many beginners, index funds, often in the ETF wrapper because of the flexibility and low minimums, tend to be a really solid starting point.
I think that's a very fair summary. The ETF structure often ticks a lot of boxes for convenience and accessibility for new investors, while the underlying strategy of low-cost index tracking provides that crucial diversification and cost-effectiveness.
It really does take some of the complexity out, doesn't it? Knowing you can just buy one thing, like an S&P 500 ETF or a total market ETF, and you're instantly invested across hundreds or thousands of companies.
Absolutely. It demystifies it. It shows that getting started doesn't require you to be a stock-picking genius or have a huge amount of capital. There are straightforward, powerful tools available.
So you see, getting started with investing, it doesn't have to feel like you're trying to crack some impossible secret code.
Not at all.
Understanding these basics about funds, especially getting your head around index funds and ETFs, can really put you on a much clearer, much more solid path to potentially growing your money over time.
It's about empowering yourself with that foundational knowledge.
Definitely. So, for everyone listening, what are your biggest questions now? After this deep dive into funds, what's still maybe a bit fuzzy, or what else are you wondering about when it comes to investing?
Yeah, we'd love to hear your thoughts.
Drop them in the comments below. Let us know what you're thinking. And of course, if you found this breakdown helpful and you want to explore more marginal thoughts where we try to make these kinds of complex topics simpler,
Make sure to subscribe.
yeah, hit that subscribe button so you don't miss our futures deep dives. Thanks so much for joining us today.
Thanks, everyone.